What's going on, you guys? Today I want to take a step back from the day-to-day of the markets and talk about something that's very important, and that is position sizing within your portfolio. I see so many videos, so many tweets, so many times I see people that are highly convicted about Celsius or Bitcoin or NVDA or SOFI or Palantir or PayPal. These stocks that everyone says to the moon, and they believe in it. And I think that it's important to take a step back and look at the overall balance of your portfolio. Where do these stocks that you think are going to 10x, 20x, a million X, how big of a position should you be taking in these? Now, that's for you to decide. Here's my disclaimer, of course. This is not financial advice. This is my opinion only. But I'm going to tell you why what my approach is to these names, where there's a lot of hype around them, like, oh, the growth, like Wall Street hasn't discovered them yet. They'll come around, so we're talking about names that, doesn't have institutional backing yet. Retail loves them, and people think they're just going to blast off and do awesome. And, a lot of these names are in my portfolio, but I noticed that a lot of people do have way too high of a position size, and I've been guilty of this too, in these names. And when you do that, it could really cause serious harm, like maybe not harm's the right word, but gut-wrenching up and downs in your overall portfolio. So let's take a look at it, and I hope that you learned something from this video. And if you do, if you could smash that like button, that of course is greatly appreciated. So we're going to take a look right now. So what you see in front of you is the S&P 500 in black, and this is over the last 10 years. And in blue, we have Microsoft. Boring old Microsoft. Oh, you never click on a video that says Microsoft to the moon, do you? However, if you invested in Microsoft 10 years ago, that money would have gotten you a 775% gain. So it would have 7x'd in 10 years versus the S&P 500, which also, did good. It over doubled. Now, you're going to see that a name like Microsoft has what appears to be much bigger ups and downs than the S&P 500. And some of these names, like SOFI, like Palantir, like NVIDIA, have even more beta. And beta means, it moves to a greater percentage than the S&P 500. However, the beauty of a stock like Microsoft is that, do you really think this company is going out of business? No, probably not. Has a great moat. It's not really going anywhere. And over time, it vastly outperforms the S&P 500. So when you experience drawdowns like this, it's a little easier to hold the faith and have conviction. Now, a big reason why people have conviction in certain stocks is, for one, they might have had recent momentum. So they're like, well, it's going up. Why wouldn't I have conviction in it? But once it comes time for that bill to come due and for profit taking to happen before the next leg up, your conviction might wane. And especially if your portfolio cuts in half, that's a lot harder. It's a lot harder to not sell after your portfolio cuts in half than it is to sell at the top and go, okay, chances are once you get to the top of this, you're going to be greedy and you're going to hold when you shouldn't, maybe. Now, also, one thing I want to show you here, let's take a look at this. What if you bought right here? What if you bought Microsoft? Boring old Microsoft right there. If you would have just bought the SPY, S&P 500, your portfolio would have experienced a drawdown of 23%. And that's the S&P 500. That's like as diversified as it gets while holding stocks. Microsoft, if you would have held Microsoft, you would have had a drawdown of about 30%. More, but not really like crazy more. You know what I mean? Now let's take a look. What about the semiconductors? So semiconductors have a much higher beta than the S&P 500. And you can see, you know, if we go to 10 years, they performed kind of like Microsoft. So what happens if you buy at the peak here? Semiconductors down 40%, and that's a sector. That's not an individual stock. That's not buying Micron or, you know, SOFI or something like that, or Palantir. So, you know, if you're going all in on a Palantir or something like that, you're going to experience a much stronger drawdown. So you need to think like, okay, I'm buying a stock like a Palantir. This thing could have wild moves. What could I realistically, with my gut, withstand a drawdown of that? You know, say that your portfolio is $100,000 and you're going 50% into Palantir, and the other 50% is like anything else. Well, you know, or just the S&P 500, that portion of your portfolio is going to come down by a quarter, and the other half of your portfolio is going to cut in half. Your $100,000 portfolio could come down to like $40,000 in less than a year, and you're going to be wondering, why the hell did I put so much money into this Palantir? Take a look at this. I want to show you like what is a reasonable, you know, like what's a market weighting for this. I don't know if you guys have ever seen this, but you know, you look at the SPY, an allocation, a market weight allocation of NVDA is about 7%. Microsoft's about 7, Apple 7, Amazon a little under 4, Meta a little under 3, Google a little under 4, so on and so forth. The NASDAQ tends to outperform while also having larger drawdowns, but not like significantly, but you know, more drawdowns. A NASDAQ-like weighting is like 9, 8.5 for Microsoft, a little over 7 for NVIDIA, 5% for Amazon, a little over 4% for Meta. And then if you go to like, so here, let's take a look at how these shake out. So let's put in the Qs, and then I'm going to put in just straight up tech, VGT. And then I'll do a 10-year. So you can see VGT does a little bit more, NASDAQ does a little bit more, like a lot of bit more actually, and then you got the S&P. And if I go to VGT, you're going to see that this has an even stronger weighting for those top three. You got Microsoft at a 16%, Apple at a 16%, NVIDIA at a 14%. Now, for me, in my personal portfolio, I don't like to have much more than 10% in any one name. So if I got 100 grand in my portfolio, I'm not putting more than 10 grand in Microsoft or more than 10 grand in Apple or something like that. I like to have a little bit of diversification, especially like not all in just tech names, because they do tend to move together. But you could see that, you know, in a name that can outperform the S&P 500, like VGT, or like an index that can outperform the S&P 500 or the NASDAQ, they have some larger weightings to really solid companies. Companies that are going to grow, they're not going to go out of business, they'll be around here in 10 years, and their stock price will almost certainly be much higher. So where does a Palantir fit into, like, what kind of size? So if you look at the SPY, you know, even Visa only gets a 1% rating in this. Now, I'm not saying you got to do exactly what the SPY does, but the way I set up my portfolio is I go, okay, I should have at least as much of the names that I like. So like Microsoft, I should have at least 7% to keep up with the market. NVIDIA probably should have at least 7%, you know, and, you know, so on and so forth. There's certain names like Google, like I don't want any Google. So I replace this weighting with Eli Lilly and Costco. Like I believe in those a little bit more. But these are not speculative names. These are like proven names. So if I go in here and I put in an Eli Lilly and I put in a Costco, I mean, look, they've outperformed 5 years or 10 years, 5 years, 3 years, 2 years, 1 year, 9 months. Like they outperform. And like, yes, they can have huge drawdowns. Like, look at this. We had an 18% drawdown in Eli Lilly just over the last month or two. But is Eli Lilly going bankrupt? No. Is institutional investment going to go away from Eli Lilly? Not for long, you know? So like you zoom out and you see this and you go, okay, cool. But like, you know, if you're investing in a Celsius, well, that company's been around for how long? Not that long. And yeah, there was a big hype train on it. Could it do really well in the future? Sure. Is past performance a guarantee of future performance? No. But I like to give my overall portfolio at least a fighting chance at outperforming with great companies that I can stomach a drawdown with. So, you know, when you look at the SPY and you see like, okay, you have a whole smattering of big companies like Visa, 1%, Costco, 1%, MasterCard, 1%, Johnson & Johnson, like 1%. So the meat and potatoes of my portfolio are going to be these names. Those are the ones that are going to get the 10%, 8%, 5%, right? And then I will have like maybe 10 names that are going to be your SOFIs and Palantirs, and sort of like you're like, man, I really think that this company has a chance to like 10x. Those will get like a 1 to a 2% allocation in my portfolio. And if they 10x, say a 1% position, 10x's, well, now it's like a 10% position in my portfolio. That's a huge position. It earned its way there. It earned its way there. If you went 100% in on that one name and you got lucky and like that one name did a 10x and you 10x, yes, you could have 10x'd your net worth or something. Or, you know, of all the names that I just mentioned, SoFi, PayPal, Palantir, Celsius, I bet you one of those four goes bankrupt, or one of those four, like the stock price cuts in half and then it stagnates for a decade. Like one of them will probably be wrong. You know, like you're not going to be right on every single stock pick that you have. And so spreading your risk among those sort of like, you know, half court shots that you think will land, like you feel like you have an edge on, if they're going to do so good, then what do you need to go all in on them for? Do a small position with them, like a Bitcoin, that, you know, that could really turbocharge your portfolio, but it won't break your portfolio. So by putting a small position on these high flyers that you think are going to like just go to the moon, you only need a small position to really turbocharge your portfolio while mitigating the risk of breaking and blowing up your account. So that's my, you know, philosophy on this. Like, you know, it's okay to have your like pet names where you're like, yeah, dude, like this name, I really believe in it. I have conviction in it. But like, you don't need, you know, a lot of it to outperform the market overall. Because here's the thing, you might pick a Palantir and a 10x's, and then and then SoFi, like all of a sudden there's a recession and like it goes out of business or something crazy, right? Now it's offset. Now you've offset your gains and stuff. And so much better to have like, you know, names like the top weightings in the S&P 500 that institutions and 401ks are piling money into. Much better to have that as sort of like an anchor. It's like a life vest of growth for your overall portfolio, and then allow some of these, you know, potential 10 baggers to make up the, you know, like the lower end of the portfolio for you. Just like the, you know, in the S&P, you know, like these first two pages only make up about 30% of the portfolio. And then you've got like 450 companies making up 0.5%. Like you don't need that. You don't need, like, in my opinion, I don't need that much, you know, like first of all, like Netflix in my portfolio deserves more than 0.64% of a weighting, right? And then like a name like Chevron or something, like or Merck, I don't even want that. So like that can go. And so outperforming the S&P is not that hard if you replicate what their biggest weightings are, you know, to a level that you're comfortable with, and then picking some favorites and going a little bit overweight on those favorites, and then replacing, like, you know, all of these like fraction of a percent with your personal picks. You know, in the big picture, you can outperform the market. That's how I approach it. So I hope that you found that insightful. I hope that you enjoyed that. If you totally disagree with me and you're like, nah, man, you got to go highly concentrated into this obscure biotech because it's totally going to get patent approval and it's totally going to change the world, God bless. You can leave your comment below if you like. What are your, that's actually what I want to know. What are your high conviction names that you might have too big of a position on at the moment? Leave those comments below. I'd love to see it, because sometimes those are great additions to a portfolio in the right proportion. So love you guys. Have fun trading. Don't be too risky, but you do have to risk a little bit for that biscuit, don't you? And I will catch you on the next one.